Right guys, so in today's video I wanted to take you through a complete guide to the ICT Silver Bullet. We're going to be looking at examples from the New York AIM session and also the London session. Again, let's get straight into it. These types of videos, I enjoy making these. This PDF, if you want this guys, comment below PDF and I will upload this in the description of the video, so keep that in mind. Now just to cover the basics, what is the Silver Bullet? What are the time frames? The Silver Bullet that ICT came up with, they're just key windows in time where the price should, offer an opportunity to go long or to go short. And there's a typical entry model that we'll talk about. We'll talk about some of the things that are, kind of maybe flaws with the entry model, but also situations where it does work really well. Again, the Silver Bullet for the London session is 3 a.m. to 4 a.m. All these times, by the way, these are New York times. So my trading view chart is set to New York time, even though I'm from Australia. That's just the standardized time that most people use. So 3 to 4 for London session, which is what I personally trade, 10 to 11 for New York AIM session, and 2 to 3 for New York PM session. Again, it's during this window that ICT has mentioned or talked about a typical entry model. And you've probably heard of it again, a sweep of liquidity, a market structure shift, and a return to a fair value gap. We're going to talk about this in more detail, but also talk about different ways to use the time frame of Silver Bullet to actually execute on a trade. And we'll start with this, right? This is from the New York AIM session, 10 o'clock and 11 o'clock. So let's get into illustration number 1. So first and foremost, in the image below, I've illustrated the 3 components of the Silver Bullet entry model. A sweep of sell side with a red line, which you can see is right here, a market structure shift here, and then I've illustrated a few things here with different colors, which we'll talk about, but we'll extend on this as we go through. Now, in green, I've marked out fair value gaps, right? So there's a fair value gap from this candle's low to this candle's high, from this candle's low to this candle's high. There's 2 fair value gaps in green, bullish fair value gaps or busies. There's also an inversion fair value gap here. Now, just to clear it up, to simplify things, unless there's a breaker block over here, right here, high up in this move, I would expect price, right, and rather take an entry below 0.5. Again, when you're talking about discount premium, the best entries to go long come in a level of discount. What's discount? You grab the previous range from this swing low to this swing high, you mark out 0.5, and this here is your OTE zone. You won't always get optimal trade entry, but price can come back down into OTE if it wants to, but sometimes you're going to be reaching too much and you won't get filled. So the best thing that I personally do is, if I'm thinking price might come down there, I might slowly add into a position. If it comes down there, then I'll enter again. If not, completely fine, I enter with the 1 contract and then ride that up. That's completely cool. So again, we've got a sweep of sell side, a market structure shift, price returns back down. Why don't you enter up here from this fair value gap? Because it's above equilibrium. Where's your stop loss going to go? If you enter here, you have to permit price. Here's the thing. ICT mentioned this time and time again, you have to permit price to come down into the bottom fair value gap. So essentially, you're going to enter here, and this is New York AIM session. Your stop has to go at least below this fair value gap, at least. And ideally, based on the model, it's going to go below this swing low or these bodies. That stop loss is way too wide, and as a result, you're going to tarnish your risk to reward, meaning you can't put as many contracts on, you can't get as much out of the trade, or you can't get as high of a risk to reward if that's what you're, personally aiming for. So again, I've marked out these bullish fair value gaps in green, and I've also marked out this inversion fair value gap in orange, which is important to keep in mind. Notice in this example that there are multiple fair value gaps. We talked about that. And the first point to keep in mind is that fair value gaps are good to buy in a level of discount, sell in a level of premium, buy in a level of discount. This will actually eliminate a lot of losing trades. Yes, you might miss out on trades, but you're going to eliminate a lot of silly trades by doing this. Another way to approach this is to consider where multiple PD arrays actually line up. So for example, you've got an inversion and you've got a bullish fair value gap. That could be a limit order, or below 0.5 right here. Really good, right? So that's just the first thing I want to talk about. This is what it looks like typically, and then we're going to get into some more detail about, different price signatures, what to look for, when it works, when it doesn't, different things that might strengthen using the entry model, and things where it doesn't really work, and you've probably experienced this too. So let's get into the next slide. Now, what we're going to do here is we're going to extend on this potential trade here, right? By all means, you could do something like this, where, for example, if I just zoom in for you guys, you could enter here, right? Put your stop loss below this low or below the bodies, and you can target a 1 to 2. that's completely fine, right? Completely fine. But for me personally, I don't like doing this. Number one, the stop loss is too big. And number two, I won't have to wait a long time to get that feedback. I would prefer that instant feedback, 10, 15 minutes. I'll know if I'm in the wrong or the right, and I can adjust my trade as per fit, right? So again, by all means, you could do this. You could go for a 1 to 2. However, entering from the retracement alone, in this case, it's not the highest probability trade. So if you want to adapt the ICT typical silver bullet entry model, here's something that I really like to use. And it makes use of a few concepts, and we'll talk through it in a bit of detail. And this is the illustration right here. So again, price comes down, we tap below equilibrium into a level of discount. We also sweep sell side in a level of discount. Important. Sweeping sell side in a level of discount when you're looking for longs is the first thing. Sweeping sell side in a level of discount in a fair value gap or inversion fair value gap is the next point. So again, we sweep sell side in a bullish fair value gap in an inversion fair value gap. The question for you is, once we sweep this sell side, do we aggressively displace down or do we reject? We reject. When we reject, what do? We create this inversion fair value gap. So using the image above, notice how you can see we've got that further sweep and we've got a further, look at this, a further inversion fair value gap right here. This bearish candle gets inverted with some displacement. If you wanted to enter off a bullish gap, you can. That's completely fine. But you don't have to, right? So you could enter off this inversion, or if you want to enter from the retracement, it comes back down and it could tag you in. It doesn't have to retrace though. This is like the ideal situation. So the reason I'm mentioning this is because a lot of people might have faced this, you might have faced this, where you get the retracement, you enter, and then price just keeps going low. You're thinking, what? I've got a rate of liquidity, a market structure shift, I've got a fair value gap, I'm in a level of discount. Why is that wrong? Because it doesn't have as many confirmations. I shouldn't say wrong, but there's not as many confirmations riding on that trade. By this point, you've got the initial tap back into the fair value gap, you've got the rejection, the next inversion, and you've got now all of this low resistance liquidity, which we'll talk about in a second. And that's all I'm mentioning here, right? So these are really the setups that have, the higher win rate. These are the ones that may not occur as often, right, on a 1 minute time frame, but they do occur a lot on those smaller time frames. For example, the 30 second or the 15 second. This chart here, just so you know, is from the 1 minute time frame. So you will see these things happen, and these are opportunities then to go, okay, my stop loss is much tighter, and to get a 1 to 2, I don't need the price to go as much. I don't need to wait in that trade as long. The longer you're in a trade, in my opinion, the more that price can do. That's as simple as that, right? If you're in a trade for 2 hours, price can fluctuate a lot more. If you're in a trade for 1 hour, a lot less. Mathematically, based on probability, for me, I prefer to be in trades and out of trades, quick feedback, right? This swing high here is sufficient when we tag that. And you might say, but what if that's not a 1 to 2? Doesn't matter. So I think a lot of people are overworked on, risk to reward. Targeting the liquidity, targeting the imbalances, take it back to basics. What's the market target? Imbalances and liquidity. So in other words, if you can sweep liquidity inside of an imbalance, inside a key time frame, silver bullet, it's a good opportunity that the market might want to retrace, right? It's a good opportunity. So keep that in mind. And again, you can see that here now. So low resistance liquidity. We've also got this accumulation pocket here, and these just make a extremely high probability trade. Again, a lot of people might ask too, this entry is outside of the silver bullet window. And for me, that's still permissible, because the setup forms during silver bullet, we can enter slightly after. Yes, if there's an entry within silver bullet, that's completely fine. But for me, that's still, still permissible. A lot of people are very strict on that, but you're limiting yourself, right? So look for the setup to form around that time frame, ideally within that time frame. If you enter within, great. If the entry is just after, great. Depending what you want to do. Again, you could enter off an inversion fair value gap right here. That's in silver bullet. If you're looking for a bullish fair value gap, that's what happens here. Now you might say to me, well, okay, Ruben, why don't I need a market structure shift here then? Because you already have that built up analysis. So going back to this image here, you don't need a shift above this swing high. You don't need that to enter here. Why? Because you've swept liquidity, you tapped into an imbalance, you've already got that market structure shift here, you've got low resistance liquidity, you've inverted this fair value gap, you retrace back into this, and you could wait. The market doesn't always give you this, but you can wait to see how price reacts here. The fact that we're not displacing lower, the fact that we're accumulating here is a really good sign, right? So These are just things to consider when you're considering the Silver Bullet entry model. These are things that make it a high probability trade as opposed to always losing, because if you're counter trend trading, or you might think you're going with the trend and something might happen, number one, if you're not waiting for as many confirmations, you could get wrecked. Number two, just because price returns to a fair value gap doesn't mean that it has to respect it. That would be you trying to predict the market, which is not as good as trying to react to the market, right? So at this point, you're reacting. If you just enter from the retracement, you're predicting. You could even wait for like a rejection candle or a change in the state delivery, whatever you want to do. But again, the more confluences you have riding that trade, the more supporting elements or PD rays, the higher the probability the trade will be, right? So that's just illustration 1, and that is from the New York AM session. This is going to be illustration 2, which is from the London session. But by the way, guys, even if you trade New York session, this will still be extremely valuable to you because it shows different PD rays and different price signatures in action. Alrighty guys, so illustration number 2. In this example, very typical example here, right? So you've got a sweeper buy side. This line is 3 a.m. and this is 4 a.m. So that's Silver Bullet for the London session. Sweeper buy side here, a sweeper buy side there. One important thing to keep in mind, it doesn't matter what session you're trading, you can have like the bigger sweep, but having a smaller sweep before you enter is also good to have, right? Because again, once the market's swept liquidity, there's always an opportunity that the market might reprice, reverse, or retrace. That's important. So we sweep liquidity, We've got our typical market structure shift, and we've got our CB here. So there's a few things, right? There's a few things happening here. Let's dig into that price action just a little bit further. Let's dig into it. So sweep liquidity. I've grabbed a Fibonacci and I've gone from, this swing low to this swing high. So essentially the best way for me to describe it is when you see that shift happen and then you start to see price retrace, when we form this swing low here, probably when price is about here, I would then consider that a range, because now what we're doing is we're displacing back into the range. At this point, I wouldn't really consider that a range. Even though we've got a swing low here, we haven't started to displace back into the range. At this point, we have. Now, the next step or the next question you might ask is, which fair value gap do I use? And it's a similar principle to the last example. We've got a sell side imbalance here, a sell side imbalance here. It's always ideal to use the one that's at the top. It's always ideal. And in this example, see this last down close candle? That's a breaker block. So this is actually a typical unicorn entry model. We've got a rate of liquidity, a shift in structure, a return above equilibrium again, sell above equilibrium, buy below. Tapping into a breaker block during Silver Bullet time frame. There's a lot of confluence on this trade already. You get me? So in this case, the fact that you got a breaker block, the fact that you got that internal sweep, the fact that you got this placement, and one last thing, the fact that price is struggling. Look at this, 1 candle, 2 candles. Price is struggling to even close at the halfway point of this sell side imbalance. It's telling us something. It's telling us that the market does not want to go higher just yet, and we're looking to reprice. So even though you don't get that extra confirmation, like by the time we inverse this, it's too late, right? You've missed the trade. You can wait, right? You can wait for these extra things. You can look at price here, look at price here. When price does this, close proximity entry. You're still using the overall model, but it gives you that further confidence. Your stop, right, depending how confident you are in the trade, can go above the actual fair value gap candle. It can go above this high. Realistically, you can put it above 3 PD rays. One is this fair value gap, one's the breaker, one's the order block, and that should be sufficient. Why should price disrespect this fair value gap and the breaker? It doesn't really make sense, right? So you're putting your stop loss in a place that makes sense. And yes, sometimes you're going to get stopped out. It happens to me. You might trail your stop too quick. You might put your stop loss in a place and it just wicks you out and reverses. But that's okay, because that's made sense to you in that time. And it's never too late to enter again if the analysis is still in play and if the draw liquidity is still in play also. So keep that in mind. Again, ask yourself this question all the time, right? When you sweep liquidity, does price reject after sweeping liquidity, or does it push through? That's important. Like if we push through, it's different to going up and then rejecting. Look, it's just a wick. It's just a wick. Wick, we try, we can't do it, displace. Right, there's a few other things here too we've talked about. These up close candles, when we break below that here, that's a change in the state of delivery. So there's a lot of confluence riding this trade, allowing you to, to enter the trade. And again, you can see that here. This is me using the Fibonacci, right? We've mentioned that here. using the Fibonacci, that's your shift in structure, you can see that, and price retraces just above 0.5, the body's barely closed, and then we displace lower. So it's something that's really, really important. The market structure shift with displacement, yeah, it's important, but I will show you examples where you don't need the candle to close below. It honestly all comes down to, right, it all comes down to how many other confluences are riding on that trade by the time that you're willing to enter. Is there 1, 2, 3, 4? You know, that's what makes the difference. So if you see people just entering simply off a change in the state of delivery or simply off a market structure shift, there's probably other confluences, probably other things going for that trade, just not that one thing, you know what I mean? So that's something to keep in mind, always keep that in mind. And again, guys, if you like these types of videos, let me know. I do really enjoy making these PDFs. I do enjoy educating. And again, if you have any ideas for videos, leave them in the comments below and, you know, I might get to it. So these are the important things because a lot of people don't teach you this. They talk about, oh yeah, you just look for a rate, a shift, return. It's not always the case. It's not always clean. It doesn't always look pretty. But there's some things to always ask yourself. Always ask yourself these things when you're trading. Keep that in mind. And again, this is a unicorn entry model. So honestly, I don't think it matters too much how you enter, but just make sure you've got those clear targets and make sure that there's a lot riding on the trade. Because for example, if there's no breaker block there and we didn't displace past this low with the body, it probably wouldn't be as high probability. Is there low resistance liquidity? Is there not? These are things that you've got to ask yourself when you're taking the trade. Again, this is what it looks like here. So we've got a sweep of liquidity, a shift in structure, entry as price just retraces into the fair value gap. The stop can go above the high. That's completely fine. And that there is your, you know, your 1 to 2. But Ruben, what about this? What about this, Ruben? Why does price not return to number 2? Why does price not return there? I had a limit order set. My limit order set for number 2. I wanted to get back in on the retracement. Why didn't it return? Let's talk about it, because this is something else that might, you know, limit you in your trading and limit your ability to get into a trade. It's called a breakaway gap. But why do these form and how can you anticipate these to form? Let's get into it too. So looking at this example, if you missed number 1, you might go, okay, I'm going to enter from number 2. That's fine. And why is that fine? Because I've defined here a dealing range. If you guys want me to make a video on dealing ranges, I can do that also. And maybe I'll include, you know, some things about optimal trade entry, dealing ranges, price behavior. We can do that. Let me know. This swing low, right? This swing low at the bottom, this swing high at the top. That's my dealing range. Why? Because this swing low swept that low, this swing high swept that high. So it's a range. They both swept liquidity. That there is the low, that there is the high. We've started to progressively move lower. Ideally, any shorts have to come above equilibrium, right? Those are the highest probability trades because as you get, here's the thing, as you get further down, we'll tap eventually we're going to tap into OTE of this previous range. And again, it doesn't have to, but price can always reverse or retrace in OTE of any range. So again, if you're going for a short here, what if we just reverse from this fair value gap? We could, right? We could. So the lower down you are, right, in a sell move, the lower the probability. The higher you are, the higher probability. But you might want to wait for the extra confirmation. And unfortunately, price doesn't always let you enter after, you know, we've created this massive down close candle. So let's talk about it. Now, what if you miss your first entry? Now, this is dealing ranges. And again, we've denoted the number 2 above the 0.5 level. And let's talk about why this forms and how you could anticipate this to form. Now, just to extend on that, I've marked out this inversion fair value gap. So you've got a bullish fair value gap here. We trade back into it here. We use that as support. Then we disrespect it. Now, 2 things. Number 1, the way that we've actually disrespected this bullish fair value gap is important. And number 2 is this accumulation here. 2 things. We come up, we displace down. If the market is really bearish, take it at a simplistic level. If the market's really bearish, would you want to see price return all the way up here after displacing with such force? No. To extend on that, the fact that we've got an inversion fair value gap here is important. If there's no inversion fair value gap here and it's all like immediate rebalancing, right, there's no fair value gaps, then of course price might return and then we can head lower. Where breakaway gaps will often form, right, number 1, when the market is extremely bearish. Again, we talk about that here. The market's really bearish, but when you've got an inversion fair value gap on the left-hand side of the curve. So a lot of people go to me, well, how do I know it's going to be a breakaway gap? Or do I have to use things that are on this side of the curve? I personally would. because any bullish gap here is going to be important. How you trade past that's important. Do you respect it? It's important. Same thing here, like in this move down here, in this move down here. If we eventually move up, then these fair value gaps could become inversions, and we'll see how price trades in those, right? So again, we've now dipped below 0.5 and we're accumulating at 0.5. Why are we accumulating? We're accumulating more short positions. So the fact that we've closed with such aggression and there's an inversion, I would personally rather see price accumulate. You can see price doing that and expand lower. That is just the ideal situation. So if you're in a situation and you see price aggressively push, create an inversion and then start to accumulate, it's more ideal in my opinion for price then to just continue in the same direction that's already been initiated, as opposed to accumulate, come up here. It's not as high probability, because that would mean that price might be using these candles as an order block to push higher. So I hope this is all starting to make sense, right? This is where you can anticipate a breakaway gap to form. Does it have to? No, but there's some situations where it probably will form more often than not. And I think it's an important thing to talk through. Alrighty guys, so let's get into illustration number 3. And you can look at this, right? Look at this bigger price swing. Obviously we're trending up, and this here is the silver bullet, right? This is the New York session. Silver bullet's roughly from here to about here. Now you might say, well, that short position, it's not enough. It's not enough. Like, price barely comes down. The real move, the better move was to take longs. But depends how you look at it, right? There's always two sides of the coin, because with the silver bullet entry model, guys, there's actually no magic risk to reward. The best success that I've had trading in silver bullet is targeting the low hanging fruit. And if you want to leave a runner, leave a runner. You know what I mean? Because in this case, you're counter trend trading. The market's moving up. You can see that. This is the 1 minute time frame. And you can see we have all the elements here that we need. We have a sweep of liquidity. And you might say, what about this? That's not a market structure shift because we don't close below. We close below here, but not with aggression. One thing to always look for in the markets, guys, is any failure swing highs or any SMT. So for example, if the NASDAQ made lower highs here and ES made higher highs, and we have a failure swing, which is just a swing high that fails to take out the previous one, that indicates something to us. That does. That indicates weakness in the NQ pair, and it could occur vice versa. And therefore, I wouldn't really need to see, price close below, because we've swept liquidity, we've got SMT, and look what price is doing here, and we've got a fair value gap. Now we could extend that even further. We talked about breaker blocks. We can talk about mitigation blocks here. A mitigation block is very similar to a breaker block. If this swing high swept that swing high, everyone here would class this down close candle as the breaker. A mitigation block is just the opposite. When this swing high doesn't sweep that swing high, the down close candle here is the mitigation block. So again, mitigation block, S&T, failure swing high, silver bullet, return into this fair value gap, sweep these two highs here, tap into the mitigation block, project lower. Take out that level of sell side and then retrace. So that is still the typical silver bullet entry model, but it's applied in a different context, which I think is important. Taking price to the low hanging fruit, there's nothing wrong with that. It doesn't mean you're a bad trader. Like if you just took a trade to here, which might be, say you entered here, stop above this high, it might be a 1 to 1.3. It doesn't mean you're a bad trader. It means you're trading to what the market conditions are giving you. You know what I mean? Because then, yeah, price reverses up, but where's your entry model here? You get me? So it's all about giving, or adapting to what the market gives you. That's what I'm talking about here. When you see, a failure swing high, and when you see a market structure shift, a return to a fair value gap, it doesn't mean price is going to completely reverse and go 100 handles or 200 handles. It could, but it doesn't have to. So a lot of people ask me, and this is how I've adapted my own trading style and strategy, is just to target the low hanging fruit. If you want to leave runners, leave runners. Look for low resistance liquidity. If there's low resistance liquidity and it's like 30, 40, 50, 60 handles, then fine. If that's your entry model, go for that. But honestly, consistency with small amounts, in my opinion, is much better than always trying to target these big swings, always demanding a 1 to 2, 1 to 3, just a fixed risk to reward, because the market's not always the same. That's like really, really important to keep in mind. And when the market's not the same, you can't expect to use the same entry model. You know what I mean? So it's just something to keep in mind, right? It's just something to keep in mind. And another reason why the silver bullet entry model, the typical one, won't work is because of this. And let's talk about it. So this is the last slide again. Please, guys, if you enjoy this, let me know below. Give this video a like if you like this new format of videos. I do really enjoy it. And if you have any questions about this or anything, leave them in the comments below. I'll see all the comments, right? And I'll try my best to reply to them in the soon time period. For those that are still here, I appreciate you guys, staying to the end of the video. If you've made it this far, right? If you've made it this far, comment my name full view in the comments. Just so I know who, who's that person or who are those people that stay, because a lot of people might come and go, but I do, appreciate you guys staying for the video. So if you are this far, comment full view below and I'll know who's, watching and who's kind of, staying for that time frame. So again, illustration 4 is what happens when price sweeps a previous day low, a previous day high, previous week low, a previous week high. Look at the reaction here. We sweep that previous week low. This is in London session, by the way. I think it's from, a couple of days ago, last week. Look at that. Now, this is a situation where the typical silver bullet entry model, it's probably not going to work. It's probably not going to work. You might get a sweep liquidity, which we do. You might get a market structure shift, but no return. And you've got your limit order set there. Yeah, beautiful. Price is going to return. It doesn't have to. It does not have to. And why? Because you've just swept liquidity from quite a long time ago. And we've got low resistance liquidity to target. So again, of course, the market is going to offer opportunities. The market's going to offer these pitch perfect examples, where you sweep liquidity, market structure shift, return, beautiful, respect the 0.5, but it doesn't always do that. And I think it's important to keep in mind, right? Have an adaptable strategy. You sometimes have to adapt, and that's as simple as it is, right? In this example here, you can see that's the sweep of liquidity. We've got a change in the state of delivery above this down close candle, an inversion fair value gap. Let me just zoom in and come across. Inversion fair value gap, market structure shift. In this case, because of the low resistance liquidity, because we've got multiple PDRAs and things happening here, you expect a really sudden and abrupt move. And you can see we have the shift. Do we return to this fair value gap? No. Do we return to that fair value gap? No. Do we return to this one? No. Do we return to that one? No. Why? Because there's a lot of low resistance liquidity above, and I'd encourage you, last week, have a look, London sessions between 3 to 4. Have a look at these type of things, guys. Have a look for these things. And you might have experienced this before, but I want to talk about, in this video, why sometimes it works, why sometimes it doesn't. I wanted to cover everything. So after watching this, hopefully you've got an understanding of obviously what the typical silver bullet entry model is, maybe how you can adapt that to form a high probability structure, and some situations where it probably won't work out, right? And that's kind of what I've mentioned here. Again, if you guys like this video, let me know. If you don't mind, these longer form videos, also let me know with this format. And until next time, guys, I appreciate all the support. I'll talk to you then. Peace.